Welcome to the Explainer. Let's just jump right in because, look, that era of consequence-free, growth-at-all-costs funding, it's officially dead. For a whole decade, tech founders were rewarded purely for speed. Widening losses were just kind of brushed off as strategic investments, and staggering burn rates were heavily praised as aggressive scaling. But the market has completely shifted, and the rules of the game have fundamentally changed. So today, we're putting the entire startup ecosystem under a microscope.
And I really want you to ask yourself a serious question as we look through this data. Is your favorite tech unicorn, or hey, maybe even the company you work for right now, truly scaling an empire, or are they literally just days away from a total fire sale? I know, it's a brutal question, but the financial data we're unpacking today basically demands an honest answer.
Okay, let's dive into this. We are directly contrasting two entirely different realities here. On one side, you have the hard, gritty, disciplined reality of building an actual sustainable business. And on the flip side, you have the sheer vanity of incinerating venture capital cash just to live a lavish, high-growth startup lifestyle, completely lacking any underlying economic foundation.
Which brings us right to our core thesis for this explainer, and it's a provocative one. Most tech unicorns aren't actually building empires at all. They're just burning through billions to subsidize a lifestyle they absolutely cannot afford. A lot of these massive, flashy valuations we see in the headlines, they're really just shiny facades covering up ticking financial time bombs.
All right, let's get into Section 1, the growth delusion and the medical diagnosis.
To really wrap our heads around what's happening, we need to do a forensic audit of startup financials. We have to stop obsessing over vanity metrics and start treating these numbers like a patient's vital signs. Take a look at this massive study of over 6,000 Spanish startups, which analyzed their survival rates up to 8 years after creation. What the researchers found is that even in the super dynamic, high-tech space, basic math just doesn't lie. Startups that showed actual profitability and healthy working capital early on, the actual cash you have on hand to keep the lights on, along with low debt, had significantly higher survival rates. This proves that structural inertia is very real, meaning early bad habits get permanently baked into a company's DNA. If your financials are a mess early on, they almost never magically fix themselves later. Profitability and low debt dictate survival. Hype absolutely does not.
Moving on to Section 2, 3 root causes of burn.
So, how exactly does this happen? How does an uncontrollable burn rate sneak up and just ruin incredibly smart founders? Well, Jason Lemkin over at Sastra breaks this down into 3 core operational failures. First, you have companies with high customer churn expanding way too fast. Think about it. If your customers aren't even sticking around for 12 months, pumping massive amounts of money into sales and marketing just creates a giant cash furnace. Second is delusional fundraising. This is when founders raise an easy round and just kind of assume the next one will be a breeze too, even while their internal metrics are completely tanking. And third, they lose their scrappiness. You see this all the time. Bootstrapped founders finally raise big money, hire a bunch of VPs, blow up the marketing budget, and suddenly their burn rate is 50% higher than they can actually afford.
And this right here, this is the ultimate red flag for investors. When founders show off a financial model with all their monthly expenses, but completely fail to explain how many months of runway that cash actually buys them, or what concrete milestones they'll hit before needing a bailout, investors hear one thing loud and clear. They'll come back asking for more money in 8 months without hitting any milestones. It just screams a total lack of capital discipline.
Which brings us to Section 3, the lie detectors, burn multiple.
It is time to introduce our first ruthless financial lie detector. This is the metric that separates the true scaling empires from the cash incinerators, the burn multiple. Created by David Sachs, it's super straightforward. You take your net burn, the actual cold hard cash leaving your bank account, and divide it by your net new annual recurring revenue, which is the real money actually coming in the door. It completely strips away the illusion of top-line growth by asking one devastating question: at what cost? It exposes exactly how much cash a company has to burn just to acquire a single dollar of new sustainable revenue.
When you actually look at the industry benchmarks for this, the reality becomes crystal clear. If your multiple's under 1.0, you're doing amazing, excellent capital efficiency. You're generating revenue effectively relative to what you spend. 1.0 to 1.5, still strong. But anything above a 2.0 means you're burning cash dangerously fast. At that point, your growth is basically entirely subsidized by venture capital, which is a massive red flag for long-term survival.
I really want to let that sink in for a second. A 2.0 multiple, literally,
means a startup is spending $2 whole just to generate one single dollar of new recurring revenue. $2 out, $1 in. In literally any normal business context, spending $2 to make one is a high-speed train to total financial ruin.
Next up, Section 4. The lie detectors. The Rule of 40.
Let's look at our second lie detector. This is a metric that totally destroys that common founder excuse of, strategic investment losses. It's called the Rule of 40. It's pretty much the ultimate structural health indicator for a SaaS company at scale. The math is simple, but totally unforgiving. Your year-over-year revenue growth rate percentage, plus your profit margin percentage, usually measured by EBITDA, your core operational profit, must equal at least 40%. If you hit 40 or above, you're doing it right. You are successfully balancing rapid growth with sustainable profits.
Now, what's really fascinating here is the future of ventures trade-off matrix. It literally forces leadership teams to look in the mirror and admit exactly what kind of company they're running. High growth and high margin, you're elite. Congrats. But high growth with deeply negative margins, yeah, you aren't some genius disruptor. You're just incredibly venture dependent. And if you have low growth and low margin, you are severely at risk because you're not just managing a metric on a spreadsheet here. You are choosing your entire capital strategy.
And hey, if you think hitting that Rule of 40 is easy, think again. A massive McKinsey analysis looked at over 200 software companies across a full decade. Guess how often they actually hit this 40% threshold? Only 16% of the time. Seriously, consistently operating at or above the Rule of 40 is absolutely the exception, not the norm. It requires an insane amount of discipline.
Okay, finally, Section 5, the ultimate question, default alive or dead.
This brings us to a really famous framework popularized by Y Combinator's Paul Graham. It's basically the final crucible for any startup survival strategy. We are directly contrasting being default alive against being default dead. If your startup is default alive, your revenue is growing fast enough that you'll reach break-even organically before your cash runway runs out. You control your own destiny. But if you're default dead, your expenses are outpacing your growth. You are going to run out of cash before you ever reach profitability, which means you need a continuous IV drip of VC cash just to keep the lights on. It's all about your trajectory, not just the raw pile of cash sitting in your bank account.
So how do you calculate your own fate here? It's a brutal but super simple three-step process. First, you just estimate exactly how much your revenue grows each month. Second, based on that growth, project the exact date your revenue will catch up to your expenses. That's your break-even date. And third, compare that break-even date with your runway limit. If break-even arrives before the bank account hits zero, you survive. If the runway ends first, you're going to hit a brick wall.
At the end of the day, mastering these ruthless financial metrics, keeping your burn multiple down, hitting that Rule of 40, fighting to become default alive, it isn't just about passing some spreadsheet test to make your board members happy. It's really about one thing: optionality. It's about giving your company the absolute freedom to survive, scale, or pivot without having to go begging the market for rescue capital on terrible terms. So as we wrap up this explainer, I'm going to leave you with one final, pretty aggressive thought. I want you to audit your favorite tech company or the SaaS tools you rely on every day, or honestly, even your own employer right now. Ask yourself this: if they never raised another single dollar, would they survive? The answer might actually terrify you. Thanks for joining me on this one.